Good morning. So these are our first half interim results. I'll spend a little bit of time, just a few minutes, just reminding you of who we are and about Corero. We've been operating for over 10 years. We're listed on AIM. The DNA of the company was actually in Boston. A technology company that we acquired called Top Layer more than a decade ago, and the epicenter now of our development activities are in Edinburgh, but we've also got deep technical skills in Boston, and the US is our largest market by some measure. We're a niche player in the DDoS space, distributed denial of service. We operate we have our own technology, our own IP, and we're focused on being in the network and on premises. We are sweet spot of customers are generally providers of some form or other in terms of network, telecom, content, hosting, SaaS providers. Listed here, and whilst we obviously have exposure to enterprise customers, they tend to be addressed through service providers that are providing the connectivity and network connections. We have developed a number of core technology partnerships over the years. The first one that we did was with Juniper Networks. That was about 6 years ago. They're a small investor in the company. GTT are a tier one global provider of network connectivity, and we just announced yesterday what we think could be a significant enhancement to our routes to market going forward, and also the space that we address with Akamai Technologies, which is one of the unicorn cybersecurity services companies in the world, providing connectivity and cloud computing to both service providers, enterprises, and any business that's has an online presence. Our mission, of course, is we have a significant development business, significant part of our business development. That's a ongoing journey for us. We're in a environment that requires continual product development in terms of performance, but also in terms of features to address the way threats in our space, the way threats continue to evolve in the DDoS arena. The DDoS industry is not new. We've shown this before, but just a reminder, it's been around as long as the internet's been around, basically, since Anonymous and MasterCard were taken down at the turn of the millennium. That's where DDoS got notoriety, but it's been there as a core threat to in cyberspace for many years. And this is basically all we do. We address this segment. The way we do that is with a next slide. The way we do that is we have a core platform, which is software, and around that, and that software can run on our appliance if that's the way that the user or the customer desires to launch and operate the software, or it can operate on other standard hardware, in the cloud or whatever customers might be running themselves. So we're basically a software business that happens to have an appliance if you want it, but our business model is really pure software. And then around that, we add various elements that are basically address the various deployments of how DDoS is positioned for what's called detection and mitigation in the network, in the topology of the network. I've just got one slide, and I'll hand over to Phil to take us through the numbers, and that is, I guess, a summary of the financial highlights. Next slide, please. We haven't shown this before, but it basically, we report our annual recurring revenue, but we have plotted here, and we'll continue to do so going forward, because it's quite significant, the increase in our annual recurring revenue, which is sometimes obscured by our total reported revenues, because obviously our total reported revenues include one-time CapEx sales as well as recurring or as a service sales or revenues. And in our environment, there's been a general shift to more OpEx versus CapEx, or more as a service as opposed to one-time revenue recognition. And that has a muting effect or a suppressing effect on the reported revenues. For us, of course, being a very small company, that hasn't been that disruptive over the years, because our legacy or install base has been relatively small. There are many other peers and competitors in our industry that have had to go through a period of revenue recognition correction as you shift from one-time sales, typically CapEx, to multi-year sales, where you're not recording that revenue at the instant you invoice it. You only can record the revenue over 2 or 3 years. So importantly, this shows what that underlying growth is in ARR, and it's been really significant. It's almost 170%, or a CAGR of almost 30%, since we basically started positioning this part of our in our commercial model. We started this positioning of as a service and software, so pure software sales, and that is where we think the bias will be going forward. But we're pulling this out because obviously this will be a key trend that we'd like to be obviously measured and rewarded for, hopefully going forward. So I'll hand over to Phil. Thank you.
Thanks, Jens. So our revenue came in for the half year at 10.5 million, which is up 19% year on year from H1 2022, which was 8.8 million. Gross profit was at 9.5 million compared to 7.8 million from 2022. So it was quite a high gross margin, about 90%. Last year it was up at 89%. So relatively high gross margins, up in the high 80s on that. This is how this builds down into where we get to our EBITDA. So our operating expenses were 10.6 million for the year, including depreciation and amortization, which on the face of it looks significantly up from H1 2022. But what's important to note within that is the FX movements that are distorting the comparatives. So if you strip out the unrealised and realised FX movements year on year, you actually get to operating expenses of 8.9 million compared to 8.2 million in the prior year, up 8% year on year, as we continue to invest in sales, marketing, and making sure the product remains at the cutting edge of technology. This all trickles down then into our adjusted EBITDA of 0.2 million. We adjust it for FX, unrealised FX of 0.4 million. So our EBITDA came in at a loss of 0.2 million, but when you reverse out the impact of the 0.4 million FX loss, then you get to an adjusted EBITDA of 0.2 million, which is up from last year's break-even EBITDA, and which is great that we continue to be profitable, continue to post a positive EBITDA, as well. And as Jens said, the 19% revenue increase on the back of that 13% ARR really demonstrates what a strong, solid start to the first half of the year we've had, and hopefully we'll continue to do so through the year. Next slide, please. So then we look at the balance sheet, and for me, the key point to highlight here is our cash position. So we ended up with cash of 6.2 million at the end of 30th of June, but that is having paid down all of the debt that we had with our bank term loan facility. and that was paid down at the end of H1 2023, and that was an impact of about 1.2 million. We paid off at the end of the half year. So therefore, if you compare that to, for example, at the end of December, we had net cash at the end of December at 4.4 million, and we have set cash now at 6.2 million. And that, a lot of that is the unwinding of the tied up working capital we had towards the back end of the Q4 2022 due to the seasonality of our sales. But it really demonstrates the company moving from strength to strength in terms of cash generation, and really, the paying off the debt is a demonstration to how confident we are going forward as to our ability to continue to generate cash. Next slide, please. So going to cash in a little bit more detail, as I discussed just in the last slide, we ended the half year at 6.2 million. This is the waterfall bridging between what we had at the beginning of the year, significant unwind and working capital movements, plus the repayment of the bank term debt loan, and alongside that the accrued interest, which is the 1.4 million you'll see there, alongside our continued expenditure on capital expenditure, which is pretty stable year on year, around about the million mark, and that is consistent with prior year as well. And then some other ins and outs with depreciation and amortization, again consistent year on year. So the main message here is debt-free at the end of the half year with a strong cash position and continued ongoing R&D investment, but at similar levels to previous also. Slide, please. I'll hand it back over to Jens for a strategic update.
Thanks, Phil. This is just a reminder of our business strategy. It hasn't changed. We've shown this slide before, and essentially, if you look at the outer comments, the markets we serve, the sales channels, the geographies, and the product positioning, this is basically our area of focus. And we're showing this again because if you just can remember those markets we serve, sales channels, geographies, and product positioning, and then I'll talk briefly about the Akamai relationship, which we've just announced yesterday, which was the product of many months of an existing relationship where our technology has been used and deployed throughout their considerable global network. Next slide, please. Essentially, everything on the right-hand side is what we do. We provide our technology in the main to service providers, and we provide on-premises or in the network DDoS protection in the following areas, what we refer to as edge mitigation, which is the edge of the network, scrubbing, which is where the bad or flood traffic is taken out of the network because it's contaminated the network and it's taken out and scrubbed for good versus bad data. Inline data path is another way you can deploy our technology. And I think I mentioned at the beginning, you can also employ our technology virtually and put it in other vendors' platform to run. And through the service providers, we obviously address the users. So where you see us in green, powered by Corero, that is our traditional business. In this tie-up with Akamai, they're operating previously entirely in the cloud, and they're a very large player in that regard. So this relationship basically means that they will use Corero technology in their service called Prolexic on premises, and we at some point will also be able to offer their cloud service to our clients. Some of them are already clients, of course, of Akamai, and they're a very large organization. So if I could just remind you of the previous slide without going back, the Akamai relationship basically covers all of those four quadrants of our strategy, which is addressing service providers, of which they have much larger customer base in terms of size of customer than we do. Sales channels, direct and indirect, they have their own partners, and of course they have their own enterprise customer ecosystem. And geographies, which is obviously an aspiration of ours to continue to grow, but they're in basically all of the main markets across the globe. So there'll be considerable business amplification through their channels, and they're going to be taking all of the elements of our technology, mitigation, protection, and the way that the technology is deployed as we depict here. So if you go on to the next slide, we think this relationship could be a considerable boost to our business. It's most probably going to be a game changer in terms of our reach and the type of customers we address and so on. Their core business, as I said, is in the cloud. Their service is called Prolexic. They will now be offering a on-prem version of Prolexic, which will be our technology, but provided through their solution rack. And this will be a significant and additional route to market for us with a very, very considerable player in the networking world. And we expect in the future that this relationship will most probably move beyond a commercial global partnership to perhaps something more embedded. We can't obviously say any more of that at the moment, because that's obviously dependent on how this relationship evolves, and of course what the parties desire in terms of optimal business benefit going forward. So I will hand over to, there's a last slide, if we could just move on to that, which is a summary and outlook, and then hand over to any questions from the webinar. We're happy with our first half performance. We had a flat spot last year. Having said that, we're showing, of course, what happened to the ARR in our business. We haven't had a flat spot in our ARR. That's continued to grow. We had a relative flat spot last year, like I think a lot of companies did, through supply chain issues and weaker decision cycles from customers and so on. But we're basically pretty much back in the groove or the trajectory that we've been in for the last few years. We haven't changed our strategy. Of course, we would like more customers, but we've got fantastic install base. We've got a very sticky business model. We're in an environment where it's a complicated sell. It takes time to win customers, but when you do, as I say, they tend to be very, very sticky. We've had hardly any churn in our business over the years. Our outlook is to continue to trade in line with market expectation. There are obviously a few areas of upside in our business now as a result of that additional partnership with Akamai. So I'll hand over to any questions, please.
Akamai. Now, can you talk us through the process of how they chose Corero?
Well, we'd been in their environment. They've done multiple acquisitions over the years, Akamai, and we were the incumbent in a business they acquired called Linode. We'd been an incumbent in that business for many, many years, and they acquired that business, and it's been integrated into what they call their cloud compute division. And of course, they were selling and had relationships with a handful of our major competitors in this space, and they've decided, as a consequence of their experience with our technology and the flexibility in regard to how they can embed it with what they do, they decided basically to consolidate their DDoS portfolio from what was previously two or three OEM relationships to just ourselves. So we think there'll be a considerable catchment area from two perspectives: what their install base already is, and of course what they plan to do with the new service going forward.
Okay, thank you. You talked about the stickiness of customers. Are you, when you're pitching for business, are you competing against incumbents or companies that don't already have a service?
I would say in the main, if you look at you remember there's a slide here which shows you there's 20 years of DDoS, and I said it's not a new industry and so on. The space that we're addressing is most probably moving down the pyramid, if that makes sense. The organisations or the service providers that provided belt and braces DDoS protection in the past were traditionally what's called the major carriers or the tier one. Everybody knows about the BTs and the Vodafones and the Deutsche Telekoms and AT&Ts and so on. There's a few hundred of these in the world. As you go down the pyramid, you move to, mid-sized internet service providers, hosters, data center operators. There's thousands of them. In the past, this environment wasn't overlooked, but it wasn't considered necessary to have, let's call it clean pipe or clean network connection capability. That was left to, let's call it, the very large hauliers of data traffic. That's changed considerably. Not the other day. I mean, that's basically been the dynamic of the last decade, and driven by the rise in online communities. And basically, we're in the business of protecting garbage. So DDoS basically is protecting garbage and flood attacks that undermine the throughput on the network. It doesn't necessarily do any damage. That's not what we're protecting. But of course, when you have all this garbage and rogue data, it's often used, it's analogous to a storm. It's often used as a mechanism for more onerous things to come in under this, let's call it under the darkness or in the storm, and then infiltrate your network. So that's basically the business we're in. We're in the business of getting rid of unwanted or rogue. It might not be malicious, this data, this traffic. It's just slowing you down. Now, of course, with the rise of mobile and connectivity, that's become, network degradation is a big issue for most companies that have an online presence. They don't want to tolerate blips in throughput. And how often have you been online waiting for something and you're waiting and waiting and waiting? So a lot of that is a consequence of these floods. So it's a bit of a long-winded answer, but previously this was the domain of the very large service providers. And in the last 5 or 10 years, the market that we address is coming further down that pyramid into smaller and mid-sized players in the connectivity market. And there's thousands of them. And the challenge for us is how to get to those thousands of service providers. Some of them are, reformed businesses of the past. Some of them are SaaS providers. They're providing their software online. They used to be traditional software companies, but now they've changed their business model. So it's a very fertile environment. And, we've been quite transparent. We'll continue to be transparent about this. issue for us is, of course, routes to market and how we address reaching, for a small company, reaching all these different endpoints. And we're in an international market. We're not just operating in one country. So these partnerships, such as Akamai and other relationships we have, are very important because they extend, I guess they allow us to punch above our weight, if that's the right way to put it, in terms of, we've got great technology looking for more customers. I mean, that's pretty much the space that we're in. And these OEM partnership relationships, of course, are a great endorsement that we've got something that these very large companies, think they can monetize.
Thank you. That's helpful. I can see a couple of attendees have raised their hand. Could I ask them to submit their questions in writing via the Q&A function? On the issue of partnerships, you mentioned Akamai, which was signed yesterday. Do you have any other additional partnerships in the pipeline?
Well, it's something we're studying all the time. We've been very careful and will continue to do so, that if we have other partnerships, there will be in new market segments. We don't want to create any competitive overlap. in terms of these sort of relationships, because we have our own marketing efforts as well. So with those that have followed us will remember that we had a it's not a similar, but we created a technology partnership with Juniper Networks, which are an equipment manufacturer. Akamai are a in the cloud provider of content delivery network, cloud compute, and cloud-based DDoS services. So it's really more a cyber security and cloud compute services company. They're not a manufacturer; they're a services business. And I think we will look for other relationships with maybe niche manufacturers that have a much bigger footprint than we do in other sectors, or areas of the internet, let's call it other application areas that are completely distinct from those existing partnerships. Does that make sense? And obviously the way the industry is sliced is, without getting into technobabble, is quite, there are many areas of our industry, and we think there are many other routes that we could follow in terms of partnership that would be complementary to what we do ourselves, which is of course small, but what these other large players, where they operate.
Thank you. Within the statement and the presentation there was plenty of discussion around operational gearing. So could you outline what the upper reaches of your capacity is before further meaningful investment is required?
Are you talking about how far our business model can run without? I don't think there's any particular step change required in our business model to grow. I think the two things that you should see as we continue to grow our revenues is that obviously our growth in engineering investment will never go backwards. It could only go forward. But as a percentage of our overall revenues, you should expect to see the, let's call it, sunk cost of R&D becoming a smaller percentage, even as it becomes a bigger dollar number. Does that make sense? Because obviously you won't increase the ongoing development of R&D at the pace that you would hope your revenues grow. The one thing that you would, so there's leverage there, of course. And then there's also leverage in our support services and so on, because those investments have been made. We have it's called Secure Watch. We have a embedded service which we offer all our clients in terms of round-the-clock surveillance and security monitoring. So things like that. Those things are quite scalable. They require obviously growth in personnel if you have much bigger customer base, but generally they're scalable. The one thing, of course, that we are looking for, where there will be continued growth in investment, would be in sales and marketing. But there again, in sales and marketing, the opportunity for us is not to try and double our revenues in the next 3 years and double our costs. The opportunity is to try and double our revenues in the next few years, but maybe increase our cost by a third. And the way we would do that is to go through other third parties called channels and partners and so on. And there you get, of course, you get leverage. So that's basically what our focus has been in the last 18 months, 2 years. So you would expect, we were profitable at around $20 million revenue business, which is pretty small. But then look at our margins. I mean, our gross margins are in the 80%, which is pretty much what you expect from a pure software company, which is what we are. So we don't need. There's no particular tipping point, if that's what you're asking, or inflection point where we suddenly have to make another spurt of investment. No, I think it will continue to be incremental. As I said, we're in an industry that requires total continual R&D. There's always an arms race in our industry, in all areas of tech. It's faster, not necessarily faster, cheaper, but it's faster, more functionality for the same price. So in other words, you have to keep delivering more to remain current, and of course in the cybersecurity you have to remain ahead of these threats which are evolving all the time.
I think we will say thank you both very much for that helpful presentation, and we look forward to hearing from you again in 6 months' time, and hopefully some more news in the interim. Thank you, everyone, for joining us.
Thanks for everyone for joining.
Thanks, everyone.